Good evening, everybody. Welcome to the webinar today. Hold on 1 second. I need to stop. Okay, we do have the recording going on. All right. Welcome to today's webinar. We are going to talk about Australian dollar and how to trade it against a bunch of currency pairs. So we have a lot of people already here. Can you please confirm that you can hear me? If you do hear me, type in a Y or yes, I can hear you. And I'm already getting a lot of response. I'm guessing you can hear me. And let's also, good evening to you too, Terry, good evening. And also, if you can see my screen, please type in double Y. Oh, I'm now seeing that the sound is not clear here. Can everybody, I think my microphone is working right now. All right. Good evening, Albator, Lovell, Marlon, Medit, Melissa, Orlando. Can you guys hear me? All right, so now it seems that people are actually hearing me, so that's good, and we can go ahead and start. You got me scared for a moment over here. Okay, so welcome everybody else who are joining us right now. You're just in time. We haven't started yet. It's going to be a very exciting webinar today. So without further ado, I do want to go ahead and show you a disclaimer about what trading a margin is, because I don't want you to think that I'm going to show you how to get rich within one day. Trading a margin especially is going to result in magnificent losses. What we're going to cover is how to, we're going to talk about a lot of strategies that may not be suitable to everybody. You may need to pick and choose the ones that are suitable for your financial situation, for your trading strategies, and for your portfolio. I am going to, obviously, even myself, I don't trade everything all together, and everybody is in charge of their own portfolio management. If you do have questions, definitely come to investiva.com and have a private session with me. All right, so now that we covered that, let's go ahead and talk about what we're going to cover today during our webinar. We're going to talk about, first of all, well, we had July Reserve Bank of Australia minutes. We're going to talk about their highlights, what exactly they've been looking at, and we're going to look at other Australia's economic statements and to basically figure out what is going on in Australia. It is winter there right now, and they're going to have a July Christmas apparently very soon, I think, or they already had it. Do we have anybody from Australia today in the crowd? All right. Well, my mother-in-law just went back to Australia, so if she was here, that would have been cool. But since we don't have anybody, we're going to just guess. I think the Christmas, their July Christmas was 2 days ago. And then we're going to talk about China a little bit, because China's economy really directly impacts Australia's economy because they are trading buddies. And we're going to talk about Australia's job report for June, and then we're going to get into business and do some technical analysis and come up with possible scenarios and strategies that you can use for your own portfolio. Does that sound good? Okay, great. So this is Mr. Aussie Dancing with Miss USA. This is one of the crosses that we're going to talk about today, but obviously I'm going to not only limit us to Aussie dollar pair, we're going to talk about more pairs as well, pair requests. So let's, without further ado, talk about July's RBA minutes. And so what went down in the minutes and what we know about them and what they mentioned, they can be summed up in basically these 4 headlines. First and foremost, their GDP, the gross domestic product, the growth of their domestic product was moderate in Q2, and the RBA in their minutes warned that the available data are pointing to a likely moderation in their GDP growth for Q2 after, well, don't forget that in Q1 we had amazing numbers, and they were the fastest quarter-on-quarter growth since 2012 in their Q1, and the fastest year-on-year growth since Q3 in 2012. So regarding the specific Q2 data, the RBA listed a smaller contribution from net exports and mixed signals for consumption. And so that contribution from the net exports is expected to soften because, and I'm quoting here, trade data suggested that iron ore export volumes had declined from very high levels in April and May, while coal export volumes had increased marginally. So as you may know, Australia depends massively on their iron ore and coal trade and exportation. So the fact that iron ore export volume has declined, that could be that basically defines and explains why the Aussie dollar reacted the way that it did after the minutes were out. I'm not sure if you've been following Aussie dollar. We're going to look at the chart in a moment as well. And as for consumption, signals were very mixed because retail sales had increased only slightly in April and May, but may have picked up in June. But there is an ongoing pressure to discount prices in response to increased competition in some retail markets. All right, so what this means is that, well, retail sales wasn't as significant as they hoped for, and therefore this first highlight over here that the GDP growth could moderate in Q2. All right, and so one of the other highlights from the minutes was housing market. And the RBA seems to be a little bit worried about the housing market anyway in general, and they were about it before. And the RBA meeting this time, the minutes elaborated on that. And they said that indicators suggested that dwelling investment, I'm quoting here, dwelling investment had continued to grow strongly, particularly for higher density dwellings. However, sales volume had been lower than a year earlier, and housing credit growth had eased further, consistent with a relatively low level of turnover in the housing market. And growth in rents had declined over the past year to low levels, and the vacancy rate had increased to around its long-term average. All right, so this was basically me quoting directly out of the minutes, and to put it in simpler terms, it means that supply continues to build up while demand is beginning to show signs of weakening. And you know what happens when supply is up and demand is low, right? The prices go down, and there's an imbalance in the housing market, in other words. And the RBA wasn't too worried about it, though, because the number of measures were being implemented that could dampen foreign investors' demand for new dwellings. So they're looking for foreign investors to come and buy and invest. And I mean, frankly, with everything that is going in Britain, a lot of people are actually thinking of going to Australia because they're all under the same kingdom, and there's a lot of land over there. So maybe that is what they're looking for. And in addition, the minutes said that several state governments had increased or were preparing to increase taxes on foreign investors in housing, while the major banks had increased restrictions on housing loan approvals for applicants relying on foreign income. All right, so that is one kind of mixed, again, signal on the housing market. They are kind of worried, but not too worried, because they have, so from a domestic point of view, they're kind of worried, but from the foreign point of view, they're going to increase the taxes and they're going to get their hands on foreign people's money, and they're basically going to rely on more people immigrating to Australia. All right, and so the third highlight was about Mr. Aussie himself, the Australian dollar that we're going to talk about today. And so I'm going to quote one of the phrases from the minutes. And so from this quote, we understand that the RBA didn't really try to directly talk down the Aussie dollar, but it did say this, all right? In the domestic economy, the transaction of economic activity to the non-resources sector was now well advanced, and recent data suggested that growth had continued at a moderate pace in the June quarter. Low interest rates were continued to support household spending, and the lower exchange rate since 2013 had continued to assist the traded sector of the economy. Members noted that an appreciating exchange rate could complicate the necessary economic adjustment. Ooh, all right. So this is, I mean, they didn't directly say that, hey, no, we don't like a stronger currency, a stronger Australian dollar, but they also are indicating that a stronger Aussie would make this transition to the non-resources sector more painful than it needs to be. So a stronger Aussie is therefore undesirable. They don't want a stronger Aussie dollar, and that could be one of the other reasons why we saw this switch, this downturn in Australian dollar in the past couple of days after the minutes came out. And so now we're basically going to wait and see what the RBA is going to do about it and how they're going to control basically the strength of Australian dollar. At the time of this minutes, while the minutes, like the moment the minutes were published, the Australian dollar was already feeling some pain before the release of the RBA minutes, probably because of the slide in the iron ore prices, and also probably because it was dragged down by the Kiwi when the RBNZ announced some proposed changes to housing loan restrictions. And so after the minutes were out, the Aussie was pushed lower, and the RBA minute, and probably because of the renewed rate cut expectations, because the RBA here signaled that it's open to further moves. So there may be another rate cut coming up for Australian dollar, but we don't know for sure. But people are just doing speculations, and therefore Mr. Aussie is under pressure, right? All right, next we are going to talk about China. China. Anybody from China today? You normally have a very international crowd over here. So China had a data dump around, it was last week actually, about 10 days ago. No, it was last week exactly. And if you somehow missed it, I'm going to talk about what China has been up to. And then we're going to do a summary. So in terms of growth, and I already, for those of you who just joined us, we're doing China because China is important to Australia and how they view the world. So China's GDP, their growth in Q2 in 2016 expanded by 6.7% year on year, matching the previous quarter's rate of expansion and beating expectations that it will be slow. So that was good news. All right, so far we're having good news from China. And in terms of trend, the year-on-year reading has stabilized after growing at an ever slower pace for 3 consecutive quarters. And the current reading is also the slowest rate of expansion since the 2008 global financial crisis. So now we're getting into a little bit of a mixed signal. And China is also still growing within the People's Bank of China's growth projections. So a little bit of good news again. But for on quarter-on-quarter, China's Q2 GDP grew by 8.8%, beating the readings and the expectations of 1.6%. So that was good, and that was the third fastest growth rate since Q3 2015. All right. And then in terms of output, annual GDP growth was driven mainly by the 6% increase in combined industrial output from mining, manufacturing, utilities, which is a faster growth rate than Q1's 5.8%. Manufacturing, speaking of which, together with mining and utilities, still contribute a bulk of China's GDP in terms of output. And however, so that was a little bit of a good news, which was then offset by the weaker growth from the relatively large financial industry. And so this is slower when compared to the 9.6% increase in the investment that was printed during the first half of 2015. And total trade value for the first half of 2016 also fell by 3.3% year on year, with exports falling by 2.1% and imports down by 4.7%. And then, so this was some of the bad news. And then to counter that, we had some good news, which was offset by a 6.5% increase in the National Bureau of Statistics. All right, so far we've had in the growth section, we had a little bit of a mixed signal. With inflation, the month-on-month headline reading for June CPI is still negative, so it came at minus 0.1%. However, this is an improvement over the previous month's minus 0.5% at least. Month-on-month headline inflation has been in the red for 4 consecutive months now, and the main reasons for the negative reading were the decline in food prices and the fall in the cost of clothing. And the decline in food prices in June was slower comparing to May, which is why the headline reading for June improved. All right. And then now the year-on-year CPI, we just talked about the month-on-month, the year-on-year CPI grew in March, which is slower than May's growth, which was 2%, and a 5-month low. And the annual CPI has been sliding for the 2nd consecutive month. And for reference, the People Bank of China target for annual inflation is around 3%. Crazy. The slower annual increase is mainly due to the increase in food prices on an annual basis, which is smaller than previous months. The past fall in the oil prices is still weighing down the CPI, but it seems to be passing though, because it was less of a drag in June. And other components regarding inflation had minimal contributions, which is why the core reading held steady at 1.6%. All right. Next, we're going to talk about the business conditions and sentiment. All right, the third one right over here. So the official manufacturing PMI for June came in at 50.0 and previously was at 50.1, which means that China's manufacturing sector kind of stagnated overall. The production subindex increased from 52.3 to 52.5, which is a minimal increase. And so demand, though, seems to be weakening. Payrolls contracted at an accelerated pace since the employment subindex decreased from 48.2 to 47.9. The official PMI looked bad, actually, but the manufacturing PMI from Marquette is even worse, because it dropped from 49.2 to 48.6. And this is the poorest reading in 4 months. The manufacturing PMI reading from Marquette has been below 50 since February, and the commentary from Marquette report also disregarded the official PMI report in that both production and new orders decreased, albeit only at a marginal pace. The official non-manufacturing PMI reading from NBS climbed a little bit. And looking at the components, the official services PMI had improved over the previous months. The construction index went up from 59.4 to 62, and that was thanks to an increase in construction activity. And the services PMI reported a faster rate of improvement in the services sector since its reading advanced from 51.2 to 52.7, which is actually not that bad. The rapid movement was due to a stronger expansion on business activities, and total industrial production in China grew in a year-on-year basis in June, a little bit faster than the growth in May, and that improvement was due to the increase of production output of electricity, water, and the utilities. All right, lastly, we're going to talk about, consumer sentiment. I'm sorry, the previous one was business condition. Now we're going to talk about consumer sentiment and see what the people of China are actually thinking. And the consumer sentiment and their spending, China's official consumer confidence index jumped from 99.8 to 102.9 in June. So it seems like Chinese consumers seem to be very optimistic at the moment, right? So that's good news for China. The jump in consumer sentiment translated to a strong consumer spending in June, since retail sales jumped by 0.92% month on month, and that is comparing to 0.76% from last month. And this jump broke 2 straight months of worsening retail sales reading and is the highest reading in a year. And the annual retail sales reading also jumped to a 6-month high of 10.6%, beating expectations that it will increase by 10%, same as last time. And the recent annual reading also broke 2 straight months of slowing growth in retail sales. Last but not least, we're going to talk about China's trade. And China's dollar, the China's dollar-denominated trade surplus in June was $48.11 billion, beating the expected $46.64 billion, but below the previous month's surplus of $49.98 billion. The details also take some shine away from the headline reading because the exports contracted by 4.8% on a year-on-year basis. And this marks the 3rd consecutive month that exports have been contracting on an annual basis. The imports, on the other hand, declined by 8.4% on an annual basis, and it actually has been declining nonstop since October 2014. I mean, yeah, it kind of makes sense because China mostly relies on exports and not imports. What are they going to import anyway, right? They're selling everything to everybody else. So putting it all together, the summary, China's economy, the growth rebounded on a quarter-on-quarter basis, but maintained its pace on an annual basis. The annual reading did beat expectations and is still well within the People's Bank of China's projected growth rate, which has led some analysts to believe that further stimulus from China may be unnecessary. All right, so we may not have any more surprises from China. Inflation is a weak point, and the annual CPI reading is slowly drifting lower and away from the bank's target. And while business conditions in the construction and service industries are looking good, business conditions in manufacturing sector, the main driver of GDP growth, is a bit more sketchy because the official reading from the NBS and the one from Marquee are conflicting, right? Remember that everything was kind of mixed over there. And the NBS said that business conditions are a little bit are mixed overall, but production continues to grow. And Marquee is saying that the manufacturing sector is contracting and production is also contracting. So they're kind of mixed on how inflation is really doing. And whether you believe the MBS data or the market data, that's up to you. But in case you doubt the official data, just know that you're not the only one, because some say that the official Chinese numbers are politically tampered with to put the Chinese government in a good light. So much so that some are trying to find other ways to get more reliable data. So yeah, China is not really known or renowned for being honest about what is going on inside the country, right? They even like shut down Google and YouTube and Facebook over there. They don't want people to know what's going on. They don't want people inside China to know what's going out. So in terms of that, in terms of inflation, we really don't know, and analysts are kind of mixed on it as well. Going back to GDP growth industry, which includes the manufacturing sector, still accounts for 33.98% of China's GDP, which is pretty huge, and also shows that the Chinese government desired to shift away from an export-oriented manufacturing economy to an economy based on domestic consumption. High-tech industry and services is not progressing very quickly. And at the same time, business investment slowed, and both exports and imports have been contracting. So there is still some vulnerabilities in Chinese economy, albeit it wasn't that surprisingly this time around. All right, we're getting questions over here. All right, so yes, this webinar is going to be recorded, and you can find it later on on obix.com, so don't worry about it. But don't go anywhere yet, because we're just done with the fundamentals, and now we're going to go and do a very good old-fashioned technical analysis on Aussie crosses. So bear with me for a second. All right, so now we're going to, if you actually want to do some practice, go ahead and open up your Orbix account, your demo account. If you have an actual account, definitely go ahead and open it up. I have another question. It happens a lot when webinar people looking for how to make quick money. Yep, that's very true. We're not going to do that. We're going to teach you how to make consistent money, which is more important. All right, this is Euro Cat. We're not going to talk about that. We're going to talk about Aussie dollar first. If you have any requests, definitely go ahead and let me know about that as well. Can everybody see my screen right now? All right, great, awesome. Thank you for interacting with me. So now we're gonna go and do a technical analysis first on Aussie dollar and see what's going on. So on the fundamental side, from Australia's point of view, we saw a little bit of a downside because, well, the RBA showed some worries, and they also mentioned that they may not like necessarily a stronger Australian dollar. China, which is Australia's trading buddy, is not doing that bad, but not so well either. It's not like crazy bad, but so it's kind of neutral on that end. So with that, with basically right now our standpoint, from a fundamental point of view and a fundamental basis for Aussie dollar is that neutral with a chance of rain, right? Neutral with a chance of bearish. I also want to actually take a look at the upcoming data for Australia, so that we can keep that in mind as well. So here I'm going to go to Orbix economic calendar. You can find it very fast. There it is. Okay. So we have the economy calendar over here, and from Australia, let's see, this week, this was Sunday. Today is Thursday, July 21st, and we already had the business confidence from Australia, which actually wasn't as good. It shrank to 2, and coming up this week, all right, we don't have any more Australian reports coming up. Let's see what's going to happen next week. Over here, okay, so we have this one. We have the Consumer Price Index. And there's CPI, inflation, coming up next Wednesday, so it's a week from now. So that is when we're going to expect some volatility for Aussie dollar, for Australian dollar, right? Okay, so until next week, we can just relax and perhaps rely on technical analysis and the fundamentals from so far. That is for long-term traders, all right? So we're going to see the next week. You probably, if you will follow my videos on Orbex also, you would probably notice if I give a signal based on this next week. But so far, so we don't have any immediate actions. So for that reason, we're going to go and do a technical analysis on Aussie dollar, Australian dollar versus US dollar. Let's do that first. All right. So please keep in mind that when I'm doing this technical analysis, you also have to really pay attention to. All right, now I'm getting some people are not hearing me. All right, I'm not sure if this is my problem or Andrew apparently can't hear me. Okay, now, all right, that's good. Okay. You scared me. People are scaring me today. Stop scaring me. All right, so one disclaimer here. Today we're only talking about Australian dollar, but when you're trading a currency pair, you really have to understand what is going on in the cross-currency pair, cross-currency as well. So for example, in case of Aussie dollar versus the US dollar, we really want to know how the US dollar is doing. And well, guess what? Today we just had some major, not major actually, kind of the leading indicators out of the US, which was doing well. The jobless claim did well today. It came out much better than expected. The expectation, not much, the expectation was 265. It came at better than expected, better than last month at 253, the initial jobless claims. And then tomorrow we're going to have tomorrow's Friday, we're going to have the manufacturing PMI from the US as well as a bunch of other countries as well. And what else do we need to, I just quickly want to go through US dollar and how this has been going, and it seems like US is actually not doing that bad. All right, so today most of the reason why we might have seen this contraction was just a technical correction. All right, so I told you before, this is a daily chart of Aussie dollar, by the way. All right, this is the daily chart for those of you who asked me. It's the daily chart. And as I was talking about at the fundamentals, in the Q1, Australia did very well. And based on those results, we saw some sort of a up move within a channel for Aussie dollar. And then after the Rba Minutes, Aussie suddenly dropped. All right, so what's going on over here? This pivot level, I'm actually going to go ahead and bring it down here for now because we're going to go and start from now. This is the naked chart of Aussie dollar. First and foremost, I'm going to go ahead and add my favorite indicator, Ichimoku. All right, so this is the normal Ichimoku, the 926.52. All right, and as people who follow me on investiva.com, they might know that this is my favorite indicator as an entry point. All right. So we had a bullish confirmation previously for Aussie dollar exactly 10 days ago, and then it kind of seems like it hit this resistance level, and the resistance is right over here. All right, we're going to paint it green, and also we're going to use Fibonacci over here as well. See what other levels we have that we have to keep an eye on. All right, going to also go and click on 23% as well and bring it up here. All right. The Fibonacci here actually is not really resonating with this resistance over here, which actually kind of looks like a double top. I covered this, I think yesterday it was, yes, on investing.com, but it's not an exact double top, kind of angled double top. And I mean, when you see something with your naked eye, then you have to go ahead and confirm it with the lines and see which one is making more sense. This also kind of looks like it might be moving within an upward channel. So let's see if that is, now you see, so it's not really fitting. It already broke below the channel. So there's a little bit of tension going on in Aussie dollar, exactly the same way it was going on with the recent results. So as far as the strategy right now with Aussie dollar, it broke above the HMO cloud, but now it's trying to get inside it. It did break below a upward channel. It was not able to break above a resistance, and Australian and the RBA doesn't like a stronger Australian dollar apparently. All right. So here so far, I'm not getting a great signal as to say, hey, go ahead and trade Aussie dollar on the daily chart. Let's take a look. Let's zoom out and take a look at the monthly chart. All right. I'm seeing that people are asking questions. All right. So on the monthly chart, all right, we are seeing that this cycle over here is kind of coming to an end, while the Aussie dollar is still below the HMO class. So, I mean, there is so much time passed since the Aussie dollar broke below the HMO class. So this initial bullish bear signal obviously is expired now. But another thing that we have to keep in mind is that, well, the next HMO cloud is kind of very thick and it's pointing down. So we can see that, well, the Aussie dollar is still under pressure, and for it to go to parity, for example, over here, it has a long way to go. So the best scenario, what we can really see here from Aussie dollar on a very long-term point of view, if we also add HMO to this one, we might have a better understanding of it, right? How can I say it as default, right? We can see that this is kind of right now consolidating over here, right, with the resistance being at 0.78 and the average support being at 0.72. All right, and this month we have the spinning top with a very long shadow to the top, which kind of means that next month, in about 10 days, we might have a direction or a signal coming up. But right now, even the long-term point of view, a very long-term point of view, Aussie dollar is pretty indecisive. All right, so we did monthly, we did daily. Now for shorter-term traders, let's take a look at the 4-hour chart. All right, so 4-hour chart, we already are a little bit too late, but for a 4-hour chart, which is for a shorter-term trader, we can see that a new bearish signal has formed. So the difference between these are basically is based on what type of a trader you are. If you're a swing trader, all right. Okay, so if you're I hope everybody's hearing me again. It seems like my audio connection sometimes goes back and forth. So if you're a swing trader, if you're a long-term like position trader, it all depends. And so for a 4-hour trader who is somebody who trades more frequently, this could be a actual an opportunity, trading opportunity, because we have this signal of the pair breaking below the HMO cloud, but we still don't have the confirmation of the Senko line, the delayed line of the Ichimoku cloud breaking below the Ichimoku cloud. All right, so these are, I've talked about this during our Ichimoku courses. If you don't know about it, definitely go on investing.com and find out about it. So we don't have two signals. We have one pretty strong signal of the price says breaking below the HMO cloud, blue and an upward moving HMO cloud breaking below that, that is pretty strong. All right. So for a 4-hour chart point of view, a strategy could be, well, even right now is not too late yet because it's back basically to where it confirmed the break below the HMO cloud. So you can get in here and can target the first Fibonacci level that we already identified in the longer term point of view. You always, even if you're a 4-hour chart trader, even if you're a short-term trader, you always have to go back and find your limit and levels, you know, resistance, support, and pivot levels based on, well, a long time ago, based on the price action, the market sentiment on the daily chart and the monthly chart. So no matter what kind of a trader you are, it's always important to look at least 3 different time frames before you actually go into a trade. So based on the daily chart and the monthly chart, we found out that this point 74.38 is an important level. So if you are to get into a bearish position, and here we also have a bearish engulfing candlestick pattern, all right? So you can go ahead, get into a bearish position and target around this area. Normally when you find a level, you want to set your target a little bit loose, a little bit above the support level when you're in a bearish position, just to get the your risk management, just to do your risk management properly and have your odds in your stack. All right, so this is a short-term trade strategy. On a daily and a monthly chart, we don't have a signal. All right, if you are even a shorter-term trader, let's say you're an hourly trader, all right, you're already past that. The break below the HMO cloud happened a while back. So if you want to trade based on this, you're a little bit late. You might need to wait a little bit for this to break above the HMO cloud one more time to see that we're not going to consolidate on a very short-term basis. All right, so short-term basis, if you're trading on an hourly chart, well, your profit taking is going to be obviously a lot faster than a 4-hour chart trader or a daily trader. All right. In terms of what I'm doing right now, I am in a bearish position with the Aussie dollar, and I've been waiting for it. I'm a very long-term trader, and I wait for stuff. So if you don't have the patience, you might not want to take action on the Aussie dollar pair at the moment. We have around 14 minutes, and I'm going to cover another Aussie cross. And I may go by, let's see what I'm going to go by. I'm going to go by, we can do Aussie Q, we can do Aussie Yen. Let's do Aussie Yen because Yen has been doing crazy recently, right? Well, Japan doesn't like stronger currency and Australia doesn't like stronger currency. So this is literally a battle between prices and battle between countries, right? So this is the Aussie Yen. This is the naked chart. I'm going to go ahead and add the HMO cloud again. All right, the first inclination. We're late. We are late, my friends. We're late on the bearish with the Aussie dollar. It already, the bearish signal came in back in May on the daily chart. And right now, well, we have actually a formation of a double top chart pattern. I'm sorry, double bottom chart pattern right over here. Right? And the double bottom already completed. Right? This is a double bottom already completed. It broke above the neckline and it did the profit taking. We're here. And now the pair is inside the HMO cloud, which is again a wait and see situation. One more wait and see on a daily basis. But we're not done yet with this. Let's again zoom out and see what the pair has been doing on a longer term point of view to get a better idea. All right. So here it is. The pair for the longest time from 2009 until, well, 2014. 5 years, there was this zigzag of uptrend. It was this channel, right, of the pair moving up. And it finally broke below the channel. Not only that, it broke below the HML cloud, and this was our first indication that the Aussie Yen is going to dive down. This was February. And so now on the monthly basis, the pair is actually below the HML cloud. And how far can it go? We're going to take Mr. Fibonacci's advice on this one. And guess what? The Fibonacci 61% is exactly the support level for the pair so far. And if we add the 76% Fibonacci to the mix, we're going to see that we do have another potential for Aussie Yen for it to go lower to 67.50. All right, but so far, 61% Fibonacci level has held at 73, and the pair just kind of went back up. And you can see Aussie Yen has been developing this habit of consolidating. This candlestick went, like this month in February, it went all the way straight down. Then March, it went all the way straight up. And then in April, it went straight down. So it's been just going back and forth, back and forth. And then we had this 2 other months of it falling. Here we had this exceptional situation because of Brexit. Japanese yen became a safe haven. So that is the reason why it kind of dropped really massively after that. And now it's doing the correction because this is, again, because of the Japanese government intervention, and they're printing more and more money. Ben Bernanke was in Japan last week, and he was actually proposing to Japanese government to print out more money as well. So with that, the Japanese yen is really trying to devalue itself. So even though Australia also wants to have a devalued currency, Japan wants it also. So there is a very big struggle. But the bottom line is that if we zoom back in, is that, well, what is the cycle of Aussie Yen in general? The cycle of Aussie Yen is somewhere from parity, about 100 to about 56. It has never been below 55. All right, so this is the cycle. We're right now right in the middle of the cycle. And based on what has been happening before, you see the zigzag, and this is what the currency market does. It goes back and forth, because of what has happened before. So here we can say, all right, there is a chance that the Aussie Yen pair could actually drop again. The last time it dropped this low was in 2009. So now here's the deal, right? In 2009, 2008, it dropped because of the financial crisis, right? Because of the shock, and the Japanese yen became safe haven. Right now, American economy is not as bad as it was back in 2008. All right, so that is the difference. There's a main difference between this time around and last time around, right? And because America is in a much better economic shape, unemployment is down to 5%, GDP is amazing, interest rate is growing, like everything is really on track. So because of that, there is a chance the Japanese yen is not going to get as weak as it was before, right? So I would say, based on everything that has been going on, unless we have a massive surprise on the U.S. election and somebody becomes a president, I'm not going to name names, somebody who shall remain nameless, who might become president, who could actually create a lot of global unrest. In that case, we could see actually the 67 level. Right now, it seems like 75 around this level could be the good target. So I have a question from Andrew. Can you take the Fibo to the close of the candle or the high of the candle? All right, great question. So Fibonacci retracement 101 right over here. So when you're using Fibonacci on an uptrend, all right, you can actually, first of all, you can actually use it in either direction. But in an uptrend, it's best to drag it from the lowest point of the trend and you can use it from the body or the shadow. I normally use the body, but if you're doing the body of the candlestick, do it body, to the highest point of that trend. And this trend, well, it continued, and this is kind of the same level, so I didn't really care. And because this is such a long-term point of view, you don't really care exact point. If you were to do the shadow to shadow for Fibonacci, you would drag it actually from here to the highest point, this shadow. All right? But the point is, you see, it didn't really matter. It doesn't really matter. You can do it either body to body or do it shadow shadow. It averages out and it brings us back to the same level. And it is important that these are not exact fixed levels. So when I say the 74 level, especially when we're at this long of a time frame, at this big of a time frame, 74 level can be anything. It's a zone. It's a zone between 73 and 75, right? All this is our support zone. You should never talk about it as 74.65. No, it doesn't work that way, especially in a long-term point of view. For scalpers, obviously that is different, but on a monthly chart, it is not that different. And so the different way of using Fibonacci, from a downtrend, on a downtrend, if you're using Fibonacci, you drag Fibonacci from the highest point all the way down to the lowest point, right? And look what happened. Previous Fibonacci, actually, because I did that body to body, I have to bring it back up to body to body. Maybe, maybe not. Oh, this actually went all the way out of. So this actually created our zone. You see how I told you it's a zone? So this 23% Fibonacci and 76 Fibonacci, this created our resistance zone, our first resistance zone. And this 38% Fibonacci level from this uptrend and this 61% Fibonacci from that downtrend, this created our next resistance zone. And then we have this resistance zone, and this resistance zone. So Fibonacci, that's the beauty of it. It actually, no matter how you use it, where to use it, it normally falls into the important levels that you need anyway. All right, so that was a monthly chart of Aussie Yen. I'm going to quickly go and do a 4-hour chart analysis for you. Here we might have a delicious upcoming. So it is already, again, with Aussie Yen, unfortunately, we're already inside the HMO cloud as well. We have missed a chance. This is consolidating. Wait for it. Wait for a break below the HMO cloud. Wait for the prices to break below the HMO cloud. And if you want to wait even longer, be patient and confirm it. Wait for the Senko line to also break the HMO cloud. And then after that, you can go ahead and build up your strategy. So for those of you who don't know what this Fibonacci trading is all about and what we're doing and what the heck is going on, I have news for you. My new edition of my book, remember my previous book? So I have this brand new edition. It has 30 new pages of all the secrets that I've learned in trading the past 8 years. So go ahead and buy it. You can get it right now, 62% off actually. On right here, I'll show you where. It's on investiva.com. You go to books, all right, and just do it right now and go and claim your new ebook. This is an ebook. It's now the actual price is actually $31.99. It is now $11.99. So go ahead and get it. And then we have a bunch of other cool stuff that are coming up. So definitely go ahead and sign up at investiva.com and get this book. In this book, I talk all about the HMO cloud, Fibonacci, all the other technical analysis that I use, only one place, as well as all the secrets that I use, how to go around the brokers and make more money. So definitely go to investiva.com, get this book. And so today we had this webinar. Next week, we're also going to have another webinar on Thursday at the same time. So definitely come over. And if you have any questions after this, come over to orbx.com or email info@orbx.com, any questions that you might have. And also follow everybody. Follow us all on Twitter, Facebook. I have personal Facebook. I have Investiva Facebook. We have YouTube channels, a bunch of videos. And on Orbx, we have a bunch of videos. So we've got you covered. So definitely come over and join us, join the conversation. All right. So far, we covered today all you needed to know about Australian dollar, and we also did technical analysis in Aussie dollar and Aussie yen. We have 1 minute. You have 1 minute to ask me any questions that you might have, and I'll try to answer it within a minute. And so right now, oh my God, I think I closed the chat box. Hold on. Okay, I can see people are talking. Thank you, thank you. All right, thank you as well. It was a pleasure having you guys. Thank you so much for joining me, and I really hope that I'll see you next week. Have a great rest of the week. All right.